The next question is E21.3. Delaney AG leases an automobile with a fair value of 10,000 from Simon Motors on the following terms. So the non-cancelable terms of 50 months, rental of 200 euro per month at the beginning of each month. So the present value at 0.5% per month is 8,873. And then Delaney guarantees a residual value of 1,180. The present value at 0.5% per month is 920. And then Delaney expects the probable residual value to be 1,180 at the end of the lease term. And then the estimated economic life of the automobile is 60 months. And then Delaney's incremental borrowing rate is 6% a year, so 0.5 per month. Simon's implicit rate is unknown. So the instructions for A, what is the present value of the lease payment to determine the lease liability? So remember, when there is a guaranteed residual value, we must compare with the expected residual value. So in this question, the guaranteed residual value is the same with the expected residual value. So Delaney won't pay for the losses of the residual value. Therefore, the present value of the lease payment is only the rental. Okay. So for A, the present value of the lease liability is 8,873. And then B, record the lease on Delaney's books at the date of commencement. So this is very simple. For B, we'll just debit right of use asset, credit lease liability 8,873. Yeah, so at the date of commencement. And then C, record the first month's lease payment at commencement of the lease. So after the company lease, directly the company will pay for the first payment. So very simple, it is only debit lease liability, credit cash 200. And then D, record the second month's lease payment. After the first month, remember the interest expense will come out already. So you will have to calculate the interest expense first of 0.5% times the 8,873 minus 200. This is from the first payment. So the interest expense is 43. And then the rental payment that we must pay every month is 200. So the amortization of the lease liability is 200 minus 43, which is 157 for the first month. And then E, record the first month's depreciation on Delaney's books, assume straight line method. Okay, so very simple, we just take the present value divided by 50 months. Okay, so the journal entry is debit depreciation expense, credit, remember, right of use asset of 177, yeah, which is from 8,873 divided by 50. And then F, suppose that instead of 1,180, Delaney expects the residual value to be only 500. The guaranteed amount is still 1,180. How does the calculation of the present value of the lease payment change from part B? Okay, so the expected residual value now is less than the guaranteed residual value. So we need to calculate how much in the amount that the lessee should pay. Okay, so from 1,180, now the residual value is only 500, so the difference is 680. Now the 680 we must calculate it along with the rental payment when we want to calculate the present value of the lease payment. So the present value of the lease liability now, so the present value of the monthly payment is still the same, 8,873, just that now we need to add that 680 present value of the residual value. So when you use the single sum of the present value formula, so this is 680 divided by 1 plus 0.005 at the power of 50, yeah, because 50 months. So the present value of liability now is increased into 9,403.